Okay, let's unpack this. Imagine having access to financial insights. Insights that feel like you're getting personalized advice from, say, the world's greatest investors.
Like having Warren Buffett on speed dial almost.
Exactly, but available, not just for the super wealthy, but maybe at a much lower cost.
Right, and this isn't just science fiction. It's kind of the vision driving some really advanced AI research in finance today.
It points to a big shift, doesn't it? Beyond just chatbots that understand text.
Definitely. We're talking about models that can process all the different ways financial information comes at us. Text, yeah, but also numbers, charts, audio from calls, video, the whole lot.
And that's really the core of our deep dive today. We're digging into this based on a specific research paper.
From the ICAI 2024 workshop. It's all about Multimodal Financial Foundation Models, MFFMs for short.
So our mission here is to, well, break down this paper together. Pull out the key insights, the progress, the hurdles.
Yeah, so you, the listener, can get a really clear picture of where this is all heading and, frankly, why it matters.
Okay, so let's start with the basics. Most of us have probably heard of things like FinLLMs, financial large language models.
Right, like FinGPT, Bloomberg GPT.
Yeah.
They're good with financial text, news, reports, that sort of thing.
But MFFMs, the paper says, are the next step.
Exactly. They're designed to handle what the paper calls interleaved multimodal financial data.
Multimodal meaning multiple types of data at once.
Precisely. Not just text anymore. Think text mixed with numbers, charts, visualizing trends, tables with figures, time series data, maybe images, audio, video, all woven together.
And why is that so necessary in finance specifically? Why the big push?
Well, because financial data is just incredibly complex, isn't it? It's messy. It comes in structured formats like databases, unstructured like news articles or social media chatter and everything in between. Different formats changing constantly.
So a text-only model just can't see the full picture.
It misses huge chunks. It's like trying to understand a company just by reading headlines without looking at their actual financial statements or the charts showing performance.
Right, you need it all integrated.
Exactly. The fundamental idea behind MFFMs is that if a model can truly grasp this multimodal complexity, it can achieve a much, much deeper understanding.
Which could then streamline analysis, investment, maybe even compliance.
That's the goal. A more holistic view leading to better processes.
Okay, so the data itself is the challenge. The paper mentions a data-centric approach. What kind of data are we actually talking about? What are the key examples?
They cover a lot, but a few really highlight the multimodal nature. Take earnings conference calls, ECCs.
Those quarterly calls where companies present results and answer questions.
Yep. And they're not just text transcripts, are they? They start as live audio, presentations, Q&A.
You get the tone of voice, the hesitation.
Exactly, all that nuance. The paper uses Tesla's 2024 Q3 call as an example over 70 minutes. You have the spoken words, the tone, then you have the text transcript. A human analyst uses both.
And the market can react instantly to those calls, sometimes based on how something was said, not just what.
Precisely. But building data sets is tricky. Aligning the audio perfectly with the transcript text down to the second, that's technically hard. Small misalignments can confuse the AI.
Okay, what else? They mentioned monetary policy conferences too.
Right, MPCs. Think central bank events, like the U.S. Fed's FOMC meetings, even more complex.
How so?
You've got the audio, the transcript, and often video, body language, expressions. The paper mentions the Fed's May 1st, 2024 conference. Markets reacted immediately, stocks dipped, yields rose, then recovered, all influenced by that event.
Wow. So an AI would ideally need to process the words, the tone, maybe even the visual cues from the video feed.
That's the multimodal challenge in a nutshell. And just storing, aligning, and processing that audio, text, video data efficiently at scale, it's a big technical hurdle.
Makes sense. What about more traditional stuff like company reports?
Financial reports, yeah, a huge category. SEC filings like 10Ks, 10Qs, company earnings releases, analyst reports.
Densely packed information.
Very. Lots of text, sure. But critically important, numerical tables, financial statements, charts, graphs, all embedded within the document.
So it's the mix within one document that makes it multimodal, not just text next to an image.
Exactly. It's interleaved. And the structure, how often they come out, who publishes them, what they have to include it, varies wildly, makes it hard to process them all in a unified way.
And financial news. Similar issues.
Similar, yes. News articles are text, but they often include charts, tables, maybe video clips, links to stock data, and increasingly commentary pulled from social media like Twitter or Reddit.
Thinking of something like the GameStop saga back in 2021.
Perfect example. That wasn't just news text. It was stock charts going wild, social media posts, memes, forum discussions. A real multimodal whirlwind.
And you could see how all those different pieces influence the market dynamics.
Absolutely. And the challenges there are massive. How do you verify the trustworthiness of a Reddit post versus a Bloomberg article? How do you handle the sheer volume? How do you align the context across text, charts, and online chatter?
It's a lot. They even mentioned using financial exams, like CFA or CPA questions.
Yeah, which is fascinating. Think about those exam questions. They often give you text describing a situation, then maybe a table with financial data, a chart.
And then ask you to reason across all of it.
Precisely. To answer correctly, you need to understand the text, interpret the table, read the chart, and perform calculations. It's a great test of integrated multimodal reasoning. They make for really good, though difficult, evaluation benchmarks for these MFFMs.
Okay, so we have this incredibly rich, complex, messy landscape of multimodal financial data. How does the paper see MFFMs actually using this data? They mentioned an agentic AI ecosystem. What's that about?
Right, this is where it gets practical. The idea is that MFFMs enable what they call fiend agents. These are AI systems that don't just process information, but they observe the financial environment using all that multimodal data, and then they take action.
Take action, like making trades.
That's one possibility, but it's broader. The paper envisions an ecosystem with MFFMs, open models, and standard ways for these agents to communicate.
What kinds of agents are we talking about?
They break it down into categories. First, tool agents. Think of these as sophisticated assistants,
Okay.
like a search agent that digs through all sorts of multimodal data sources to find exactly what you need personalized. Or a tutor agent for financial education, a robo-advisor giving automated investment suggestions, even a coding agent to help build financial analysis tools.
That search agent sounds potentially very powerful. Could it really compete with something like a Bloomberg terminal?
The paper suggests exactly that. It explicitly mentions that deploying an MFFM-powered search agent could be significantly cheaper than those expensive professional terminals,
Wow.
while offering potentially comparable or even more customized access by pulling together data from many different places: web APIs, local files, databases, news feeds.
Okay, that's tool agents. What's the other category?
Financial services agents. These are more aimed at core business operations.
Like back office stuff.
Sort of. Things like credit scoring, auditing support, compliance monitoring, automating the generation of financial reports, and yes, potentially trading execution, using that deep multimodal understanding to help with critical decisions and processes.
The paper shows a diagram, I think, for a specific search agent, powered by FinGPT.
Yes, figure 4. It shows the flow. A user asks a question, maybe about a company's earnings. The agent acts like an orchestrator.
It doesn't just search text.
No, it calls different tools or components. It might access your local files, query Yahoo Finance for market data, hit a database, check Twitter or Reddit feeds, using protocols to talk to these different sources.
And you mentioned user control being important.
Absolutely critical. The framework in the paper emphasizes explicit user permission before the agent reaches out to private data or external services. Privacy and security are paramount.
Makes sense. What makes this ecosystem possible? What are the key enablers?
Two main things: open models and agent protocols.
Okay. Open models, like open source AI.
Sort of, but the paper flags an issue called open washing. Models claimed as open might have restrictive licenses. So frameworks like the Model Openness Framework are trying to clarify what open really means. Transparency is key.
And the protocols.
These are like standard languages, so agents can talk to each other and to different tools or data sources. The paper mentions MCP, the Model Context Protocol, and A2A, Agent-to-Agent Protocol. Standards are needed for these agents to cooperate.
Okay, so we have the concept. MFFNs digesting complex data to power these fin agents in an ecosystem. Where are we actually today? How far along is the development?
Well, the development usually follows a few stages. There's pre-training, where the model learns general patterns from massive amounts of multimodal data. Then fine-tuning, where it's trained on more specific financial tasks. And finally, alignment, making sure it's helpful, honest, and harmless.
And we have examples of models going through this.
Yes, the paper mentions case studies like OpenFinLM specific models like Finlalama and Finalava. They show how this process improves performance on financial tasks, especially things like understanding charts better. Fintrol and FinVis-GPT are other examples cited.
But how do we know they're improving? How do we measure progress?
That's where benchmarks come in. Quantitative evaluations, standardized tests to see what these models can and can't do.
Yeah. What do the benchmarks tell us? This is where it gets interesting, you said.
Yes, really interesting. The overall picture from various benchmarks summarized in the paper is pretty clear.
Which is?
MFFMs are getting better, especially at things like information extraction, pulling specific facts from documents or data feeds, and basic text analysis.
Okay, that's progress.
It is, and this is the big, but they still significantly struggle with tasks that require deeper financial reasoning.
Like what specifically?
Complex analysis, accurate interpretation of sophisticated financial charts, think candlestick charts used in trading, performing precise numerical calculations, and generating reliable, novel financial insights or predictions. They're not there yet.
So they might pull numbers from a table correctly, but struggle to explain what those numbers mean in context or how they relate to a chart pattern.
Exactly. Benchmarks like QFinBen show even top LLMs fail complex financial exams for certifications. MME Finance and FAMA specifically highlight that even advanced multimodal models like GPT-4o or Claude 3.5 Sonnet have a hard time with financial visual Q&A, especially those tricky chart types. OmniEvil looked at using a RAG retrieval-augmented generation where the model pulls in external data to help answer questions. It helps with factual accuracy sometimes, but the models still fall down on complex multi-step reasoning, especially involving numbers.
It really sounds like the core financial expertise, the domain-specific reasoning, is the main bottleneck right now.
Absolutely. It really highlights why you can't just take a general-purpose multimodal model and expect it to excel in finance. You need models specifically built or fine-tuned with deep financial understanding.
Which leads us straight into the challenges ahead. What are the big hurdles the paper identifies for getting these MFFMs from research labs into real-world financial applications?
They point out several major ones, and each challenge is also an opportunity for research. A massive one is proprietary data.
You mean the data held by banks, hedge funds, insurers?
Exactly.
Okay.
Internal trading logs, credit scoring data, real-time market feeds they pay for, private research reports, customer interaction data. This stuff is incredibly valuable for training powerful, accurate MFFMs.
But it's highly sensitive.
Extremely. Privacy regulations, security concerns, competitive secrecy, it all makes it incredibly difficult to use this data for training models, especially if working with external partners or even sharing across departments. The best data is often locked away.
So how do you overcome that?
The paper discusses synthetic multimodal data as one potential avenue. Generating artificial data that has the same statistical properties as the real sensitive data, but doesn't actually contain private information.
Is that feasible now?
It's being explored, but the paper notes that generating realistic multimodal synthetic data for finance is much less developed than in other fields, like, say, medical imaging. Creating realistic, correlated text, tables, and charts artificially is hard.
Okay, data access is one major hurdle. What else?
Digital regulatory reporting, or DRR. This ties into compliance.
Making sure financial activities meet all the rules.
Right. And regulations, especially in places like the EU and US, are incredibly complex. Reporting requires processing a mix of data, structured data like XBRL or SQL databases, unstructured text in reports, dynamic transaction data, even software code used in models.
And XBRL, the standard for digital reporting, is known for being complex itself.
Right. Notoriously so. So the idea of an XBRL agent that could automatically handle reporting sounds great, but the reality is current models struggle. Benchmarks show chatbots have low accuracy on questions about SEC filings, making errors in interpreting terms, understanding data context, and calculations.
So the multimodal nature of compliance data is a big challenge for AI. Does the paper suggest any solutions?
It mentions the Common Domain Model, CDM, as a potential way forward. It's an effort to create a standardized way to represent financial products and transactions, which could, in theory, make it easier for AIs to process diverse data consistently for regulatory purposes, a more fundamental data structure solution.
Beyond the technical data challenges, there are ethical considerations, right? Finance is a high-stakes area.
Hugely important, and the paper dives into ethical challenges. Some are persistent issues in AI, but they feel amplified in finance.
Like,
well, security and privacy breaches are catastrophic when financial data is involved. The paper mentions a Samsung case as a general example of leaks. Copyright infringement is a thorny issue if models are trained on proprietary research or news feeds, echoing lawsuits like the NYT versus OpenAI one.
And bias.
Systematic bias is a huge concern. If the training data reflects historical biases, the AI could perpetuate or even worsen discrimination in things like loan applications, insurance quotes, or risk assessments. We've seen worries about this with systems like Zillow's estimates or in reports on insurance pricing.
Plus the need for transparency and explainability. You need to know why the AI made a decision.
Absolutely, especially for regulated decisions. JP Morgan Chase's work on an explainable AI center of excellence is mentioned as an example of institutions grappling with this.
Are there newer ethical issues emerging specifically with these more advanced models?
Yes, truthfulness and hallucination are major worries. An AI confidently making up financial facts or misinterpreting a company's earnings report, that's incredibly dangerous. Early demos, like one from Microsoft Bing AI analyzing financials, highlighted these risks.
Hallucination seems particularly bad in finance.
It is. Also, sycophancy, where the AI just agrees with the user's potentially flawed premise or calculation instead of correcting them. Imagine asking for investment advice based on a wrong assumption, and the AI just rolls with it. Disaster.
And just general compliance.
Ensuring the AI's outputs adhere to professional conduct standards and specific financial regulations, like those from the CFPB or SEC, is a complex but crucial requirement.
So misinformation, whether from external sources the AI ingests or hallucination generated by the AI itself, is a critical risk.
Absolutely. Detecting financial misinformation is hard. The paper mentions models like FMDL Llama being developed for this, and mitigating hallucination is an ongoing research area using techniques like RR or different model training approaches.
Okay, with all these risks piling up sensitive data, complex rules, ethical minefields, potential for errors, how do we build trust? The paper proposes a guardrail framework for fin agents.
Exactly, because as these agents become more capable and autonomous, the need for trust and safety becomes absolutely critical. The framework specifically targets key risks in how these agents might operate.
What risks does it focus on?
Four main ones. One, sensitive information leaking out, maybe to the company providing the base AI model. Two, the agent relying on or spreading misinformation from unreliable external sources. Three, the agent accessing data it shouldn't have permission for, like subscription data. And four, the agent hallucinating or generating incorrect outputs.
And the proposed solution involves zero-knowledge proofs and blockchain. That sounds futuristic.
It's cutting edge, yeah.
Right.
Let's break it down. Zero-knowledge proofs, or ZKPs.
What are those?
They're a type of cryptography. They allow one party, say, the fin agent, to prove to another party, say, a regulator or user, that a statement is true without revealing the underlying information that makes it true.
How does that help here?
Imagine the agent needs to prove it followed specific compliance rules when processing sensitive customer data. With a ZKP, it could generate a mathematical proof that it followed the rules without ever revealing the actual customer data, or prove its inference was correct without exposing its proprietary model weights, ZKLLM. It ensures privacy while enabling verification.
Okay, so ZKPs handle the proving without revealing part. Where does blockchain fit in?
Blockchain provides a secure, shared, and immutable ledger, a tamper-proof record book, essentially.
What gets recorded on it?
Things like the ZKP proofs themselves, also updates to the agent's operating policies, lists of verified, trusted data sources, access control rules, and logs of important agent actions. Because it's decentralized and immutable, everyone can trust the record.
I see. So ZKPs generate private proofs of correct behavior.
And blockchain provides a public, trustworthy place to record those proofs and the rules the agent is supposed to follow.
How does this tackle those four risks?
Well, ZKPs help prove compliance without leaking sensitive data, addressing risk one. The blockchain ledger can maintain lists of trusted sources and policies to combat misinformation, risk two, enforce data access controls, risk three, and record ZKPs showing the agent used methods designed to prevent hallucination, risk four. It aims to weave together privacy, security, transparency, and oversight.
It's a complex system, but you can see the logic.
Okay.
So, wrapping up this deep dive, what's the final assessment from the paper on MFFMs? Where do we stand, and what's the path forward?
The paper's conclusion is pretty clear. MFFMs have enormous potential. They could genuinely transform financial analysis and services by integrating all this diverse data. There's been real progress,
Right.
but we're not there yet for widespread, reliable, real-world use. There are significant, complex challenges, technical, data-related, ethical, regulatory, that need to be solved first.
And the paper suggests some strategic directions to get there, to improve financial AI readiness.
Yes, several key thrusts. First, continuing to develop multilingual and multimodal capabilities. Finance is global. Data comes in many languages and formats.
Makes sense.
Second, creating more open data sets and standardized question sets. We need good open data to train better models and fair benchmarks to measure progress accurately.
Like the financial exam questions, but maybe broader?
Exactly. Third, building an open leaderboard for MFFMs and FIAN agents, a transparent way to track which approaches are working best and encourage the whole ecosystem.
And fourth,
Strategically using blockchain. Not just for the guardrails we discussed, but potentially for enhancing data privacy during training, protecting the intellectual property of the models themselves, and enabling collaborative training where multiple parties contribute data or compute securely and verifiably.
it really brings us full circle to that opening thought. The dream of democratized, sophisticated financial intelligence is closer, maybe, but the path is complicated.
Very. The technology is advancing incredibly fast, but unlocking its full potential safely and reliably means tackling these really tough hurdles head-on.
Yeah.
It's not just about building bigger models.
It's about building trustworthy models.
Precisely, building them with trust, compliance, and ethics integrated from the start.
And that leaves you, our listener, with something to think about. We've discussed this tension highlighted in the paper. The push for openness, open data, open models, shared benchmarks to accelerate innovation in MFFMs.
Which seems vital for progress.
But at the same time, there's this absolute necessity for robust governance and trust mechanisms like ZKPs and blockchain, given the incredibly sensitive and regulated nature of finance.
You need both speed and safety.
So the final thought is this. How do we strike that critical balance? How do we foster the rapid open innovation needed to build these powerful tools while ensuring the stringent safeguards required to make financial AI truly reliable, fair, compliant, and ultimately trustworthy? Finding that balance, that's the challenge ahead.